Hey guys, Freaky Finance here. Last week we looked at Disney, one that you guys probably know about. And this week we're going to look at SunOpta. Actually, I'm going to film two today and I'll probably put one out on Wednesday. I was originally going to do some utilities this week, but some of them are pretty dry. So I think I got 3 utilities I'm going to go through. So expect the next couple videos to be more stable and traditional companies, whereas these ones are kind of out there. So today we're going to look at SunOpta. Most of you guys probably won't be that familiar with this company. Basically, it's a supplier of plant-based stuff. So you know, like how all that hype behind Beyond Meat, it's a similar idea, but again, totally different. But basically, it's plant-based. It's the only real alignment there. You can see frozen fruit. They have fruit-based snacks, fruit-based ingredients, plant-based beverages, and plant-based ingredients. They also do private label, which is actually a main source of revenue for them, so you won't be that familiar with their actual end product brands, but basically they're the suppliers, manufacturers of those private labels. So we'll go through that real quick here. I'm going to jump through the financials in a second, but I wanted to just show the structure that really there were 3 key business segments: global ingredients, plant-based foods and beverages, and fruit-based fruits and beverages. Plant-based foods and beverages is the one that's been growing the fastest lately. It's also been the one where you'll see that they've been putting the most resources in, though food and beverages has been growing quite a bit as well. And you can see how much goes to retail and private label versus traditional food service. Mainly those two together, 75% of the revenue. Ultimately, grocery stores have been doing good during COVID, so retail and private label probably picked up. Food service probably slacked. Well, it did when I went through the financials during the COVID years so far. And we'll jump through that real quick here on the financials. So SunOpta. And you can see even before COVID, there was a decline, specifically in the global ingredients part of the business. So the part that was actually the biggest part of the pie in terms of revenue is actually struggling. However, GMD is down about 8 million, so not the end of the world. SGA, however, was sticky, so it wasn't responding to a decline in revenue. You can see the bottom line actually looks better somehow, but really that's just because they didn't have $81 million in goodwill impairment in 2019. There's a bit of noise in the year-over-year comparisons, but if you just look at the lower gross profit, that's pretty much the main driver of everything. Recently, the share price has rallied. Talk about that in a bit about what it's picking up on. This company was struggling, and now it's kind of on the up and up, so that's why I picked it up. It did have a decent amount in long-term debt, so 487. Now that the stock price is back up, it's small relative to its equity market value, but traditionally speaking, if you look back even just at the end of 2018, you can see that the debt was actually higher than the equity market value of the shares. I do want to point out here, the interest expense is pretty high, or was pretty high. So $35 million in 2019, especially when you're barely scraping through, because your gross profit 115, your SG is 108, so you scrape $7 million, and you're not covering your interest income, or interest expense rather. And you can see the metrics degrade year over year. And again, that's mainly due to the global ingredients weakness year over year. So quarterly, what's going on and why I'm looking at it and what the share price is picking up on is there's been some pretty strong growth, specifically in their plant-based products. So they have fruit-based and plant-based. So they're plant-based products. So that would be like your oat milk, which I'll talk about in a bit, as well as some other things. But most importantly, this jump right here is material, right? You're going from 26 million year over year to 41 million, so that's 15 million. Doesn't sound too much, but we're going from 26 to 42. That's a big jump, right? That's almost double. SGA did go up, so while revenue increased, so did SGA, but there is some scale. It didn't go up as much as revenue. Interest expense is still high relative to the take-home operating income, so it's been an ongoing weakness for some time. However, it's nearing the inflection point after their preferred shares take a cut of the net income. It's getting pretty close to being profitable, and if this recent growth can continue, then obviously it looks good. If it can't, then it's like sit in the water. And you can see the CFO pick up the 15 more million in GMD. That's really the function here in terms of cash flow. So it's a fairly simple business to understand on the surface of the income statements, but the growth prospects are pretty high, and it might look expensive because there's no earnings, so you can't really quantify that valuation. Like it's worth 1.5 billion when really that's now just over 1 time sales. Alright, so one of the things I like is the the revenue was growing, but at the same time, the margin was expanding. So not only were they selling the right things, they were selling more of the right things. That's what you're really seeing the share price react to. One, it's no longer in a decline phase, and it's been making some strategic moves lately, which we'll talk about, which is really driving the price. But it still has the fairly high debt load, 440 million, or it did. We'll talk about what happened in January. Today's date is January 23rd, 2021. But overall, when you see GM expansion at the same time, revenue still growing fairly strong, it sets up to look quite nicely, especially when you're at this phase where you're no longer, your operating margin is actually positive again. I do want to say that interest expense is expected to decrease in 2021. They sold a part of their business, the underperforming part of the business, and they did that, and they paid down 9.5% yielding debt. So, and that's expected to be 21 million less in interest expense. So this 8 million that you see here, that's pretty much 34 million a year. Expect that to go down by 66%, which is nice, because that was, I'm like, well, you're making this money, but after your SGA, you're barely slipping through, and then you have this interest expense that just eats it all up. So that's going to drive this EBITDA, or not EBITDA, but bottom line earnings actually positive by itself. It doesn't have to do anything else. It just literally less interest going to the debt holders. That's something we'll talk about in a second. And we'll also talk about Oatly going public as perhaps a catalyst for this company. So the resources, so what it's been doing has been allocating quite a lot to plant-based food and beverages. And you can see that over the last 3 years that it's been almost the other two together. So it has its three segments, but you can see plant-based is 17 million versus 9 and 9, 12 million versus 5 and 5, and 15 million versus 4 and 9. So company's been cutting back their investments in global ingredients and expanding its Capex to plant-based foods. And you can see that here with the segment assets. You can see this one going up 80% year over year, whereas everything else has declined slightly through depreciation or just not allocating resources to it. So how that looks when you look at the individual segments, well, I should start with this first. You can see the trailing 12 months of Adjusted EBITDA. It's pretty much doubled, right? It's going from 10s to 20s. And that's every quarter, which means they have been turning around this ship. And you can see the share price was already starting to react to that, right? The share price was very low during the COVID panic and even before the COVID panic. But they've been trying to make some decisions to get back to profitability. And it's starting to look like that. And that's what I like, is that inflection point, right? Like, oh, this could take off. People might think it's expensive, but how do they value that statement, right? When you don't really have earnings and you're just starting to get operating cash flow that covers your interest expense. But anyway, here you can see why they've been allocating resources to plant-based, or maybe those things are a correlation of each other. But you can see gross profit shooting up and the revenue shooting up at the same time. And they've been allocating quite a bit into oat milk, and we'll talk about that in a second, as that's a big category right now. Perhaps it's trendy, but we'll see. So that's probably their strongest business. And the fruit-based has gone down. This is when the share price was really under pressure, as it was going down at the same time as global ingredients was going down. But you can see it bounce back and flat back up to where it was in the prior year. And then this business, which they actually sold recently, the global ingredients. So again, that was about 1/3 of the business, slightly more in revenue terms. And that one was the one that went down when we went over the annuals. Let's see, that one's down 100 million, and that was pretty much the delta on the top line revenue. So you can see why they were trying to sell it. Originally, they were trying to get synergies with it, as only in the global ingredients, but as long as you lock in the supplies, you should be fine. Their strategy, like how do they actually make money, is they partner mainly with retail and food service companies. So on the retail side, your private label, basically. So your Walmart, your Great Value brand kind of thing. So you won't really see too much of their brands themselves, because they're more of the actual supplier or manufacturer. And look here, they do have, it's not to say they don't have any brands, but right here, they do have Sunrich, Sunrise Growers, and Arbor. But really they are primarily the supplier or manufacturer of the end products to the retailers. Alright, so one of the things that I like what they're doing is this right here. So oat milk with triple digit growth rate, so that's 100% or more. Oat milk is now the second largest plant-based milk, only behind almond milk. That's a pretty big deal, because that means it's beating out soy milk, and the momentum in oat will certainly provide tailwinds for our plant-based units. And much more importantly, right here, this last sentence gets me excited, is that our oat extraction facility is in the final stages of commissioning, and as previously discussed, gives us a 4-fold increase in extraction volume, so that's a 4x in capacity, which is good because the demand here is, like they said, in triple digits. To get an idea, if I go to this one, you can see here that the trailing 12 or 52 weeks before September 6th, 2020, it's a little bit dated, but you can see an increase of 350% from a year ago for the ones that you have to keep cold, and 100% for the shelf stable products. And even before that, like the year before, it was like it was almost like 600% or something ridiculous. So this thing is growing. For comp sales, you can see almond milk we're still 1.5 billion, with soy at 202, and now oat milk's at 213. It's growing pretty quick, right? I mean, it's still a fraction of the almond milk sales, so if it can keep displacing this area, let's say. And the overall category for plant-based products is growing, and there's no denying that. So one of the things that I'm looking at, well, one of the things that I really like is this. So I've harped on this already a little bit, but you can see the full redemption. Basically, they sold their ingredient business to Amsterdam Commodities for 330 million euros. And so they paid down their high interest debt, which is nice, right? So it helps the bottom line quite a bit, and it'll help their actual take home quite a bit, which is nice. I already mentioned here, but yeah, 21 million savings on an annual basis. And then they paid down their existing debt facility as well, which was the other source of debt. But getting rid of, cleaning up this high interest long-term debt is nice, especially in a low interest return world. I already talked about this one. So one of the catalysts is Oatly. So this is Oprah's backed brand. So this is actual brand that you'll see in stores, and it's not a retailer-owned brand. So this is going to get a lot of hype when it IPOs, and it's going to trade, well, like most things that have IPO'd in 2020 and 2021. It's going to be a hot thing, right? And one of the things that I don't think people realize is that this demand is pretty high, and they're going to all want this nice branded product, well, allegedly. So I can see this end product being like, okay, we need to make more. Who has capacity? Oh, this private label. Well, there we go. And then they just contract this guy out to make their Oatly product, or they literally just buy them. If this IPO is as hot as it is, they can just use their share price as currency. I mean, that's contingent on the IPO maintaining its level of what we think it's going to open at, but it would be an easy value proposition to own that vertical for this company, assuming that it is going to be flush with cash with the share price as a currency. So overall, you can see that obviously I'm a little bit behind the ball here. This thing has really taken off. So when the news broke, it was already quite high. I'm surprised it didn't react even more favorably, because some people were like, well, they just sold quite a bit of their business. I'm like, yeah, but they just sold their declining business and cleaned up their balance sheet. So there's a little bit of decision making here. It was already rallying because the underlying performance was doing better. Like I said, their EBITDA technically doubled, right? So you might be like, oh, it's more expensive. Yeah, but it just doubled its bottom line, and it might do it again, right? Thing is, this company is that you don't really know what it's going to do. You see the growth rate in some of their plant-based products, you know it's going to be quite high, and you do know that the underlying income is going to improve based on current information. So it'll be interesting to see what happens, how the company, where the share price reacts when they actually report numbers without the global ingredients business, and seeing how that looks. But to me, it looks pretty good. I do own this one. I'm in at 15.60, so I'm up like $1. So really, I got in during this little bit in the last week. But overall, it's not any kind of value or dividend play. It's really just plain a plant-based product that's not ridiculously expensive. So you get some exposure to this. I don't know if you want to call it a Beyond Meat fad or something, but you get this exposure to this growing demographic of food. So anyway, it's a different kind of company. I thought it'd be interesting to share it with you guys since I already did the work on it for myself. Ultimately, it's been on a tear. It's been up on this upward edge of the standard deviation for quite some time, which usually means there's underlying strength behind the company, which we just showed that there is. So, and that's what the share price is picking up on. So it's not like it's a great time to buy at an all-time high. But the thing is, the underlying business is getting improved quite a bit. And you still get, if people actually realize what this company does, I feel like, oh my god, it's soy-based. Like, kids will just buy it. So anyway, I'd like to know your thoughts on it. A little bit different than what I normally go through. But yeah, have a great weekend.